Howdy everyone, Greg Martin, the Entrepreneur's Banker here, and this is the final interview for Selling Your Business 360, a full circle view of your exit. And this one is a really special episode because I have a good friend of mine, Ray Drew, who is one of the best SBA lenders out there. Now, I know what you're thinking, Greg, I'm a seller of my business. I don't need to get a loan. The buyer needs to get a loan in order to pay me. And that's true. But unless your buyer has cash sitting on the side or just a lump of cash wanting to give it to you, then if they have to go out and borrow the money in order to pay you for your business, then you need to know the rules of the road. And because there are certain things that are part of the SBA program that impact your structure and impact you getting your cash. And as a seller, it's really, really good to know the information, know the rules of the road, know what it takes in order for you to get the cash that's owed to you. So I hope that you connect with Ray. If you're not connected with him on LinkedIn, he delivers you some great content. And who knows, after you sell your business, you may be reaching out to someone like Ray and getting a loan in order to start your next venture.
Well, everyone, just welcome back. I am so excited for today's discussion, today's episode. We've got a real treat for you today. We've got the man, the myth, the legend, Ray Drew, who is an SBA Business Development Officer with Fundex Solutions. And Ray has been in the banking business for a little over 10 years and dedicated his life to, and his professional life to be able to help entrepreneurs to utilize the Small Business Administration loan programs. And he's an expert in all things SBA. He is actually also the host of the SBA Lending podcast. As of our recording, he's dropped over 45 episodes with value bombs of knowledge. But I really want everybody to go and search up their podcast and look at episode 38. Where Ray specifically talks about funding acquisitions and really to be able to help with that. So Ray, thank you so much for taking the time to share with us your wisdom and your experience today.
Absolutely, Rick. Thanks for having me.
Well, I'm a big fan of you and the content that you put out because I know that you are so open-handed with your knowledge, and you've got a pretty good sense of humor, even if it is a little self-deprecating sometimes. I really loved your you going back and forth during the PPP, the dark old days of PPP, and what SBA bankers were dealing with, and I really appreciate the spirit by which you approach life. So tell us a little bit more about yourself, and I guess I just want to make sure that we start off the podcast saying that Ray's opinions or my opinions on this discussion is our own opinion. It does not necessarily reflect the opinions of our employers or any affiliates or anything like that. But Ray has been in this world for so long, definitely knows it. So tell us something exciting and knowledgeable about you.
Yeah, Greg, thanks. And I appreciate you saying that because, being a content creator in our space, I put a lot out there. So I have been called into HR a few times, but that's another story for another day. The reason I got into SBA lending was completely by chance. That's life, right? Everything happens by chance. I fell into an internship, happened to be an SBA lender. I was a marketing major in college, so I just landed the marketing internship. They hired me after college, which 2011, I was happy to take any job I can get.
Yep.
So that was my entrance in. I absorbed everything like a sponge. Then one day I'm walking down the street. There's a sign in the window. It says SBA lenders wanted, which I never thought I would see a sign like that. But I called. I was like, I gotta at least call. So anyway, that landed me my first kind of outside business development role, and I haven't looked back since. Really, I've just been doing this for now the last 10 plus years. We have the podcast now, the art of SBA lending, where I try to give back. I just feel so blessed to be in this position. So it's been a heck of a ride, especially the past 18 months.
Well, tell me a little bit about you, because you work for one of, I think it's either 13 or 14 non-bank SBA lenders. And again, we realize you're not speaking on their behalf, but that is really unique that you help entrepreneurs, but you don't work for a bank.
That's right. Yeah. I worked at a bank early on, and it was different. Okay. When you go to a non-bank lender, it's just a different environment. It's still, you're making loans. The money is the same, but the overall culture, philosophy is a little different because, and this is my second one I've worked for, both have been fairly new, kind of starting up. I like building things. That's what kind of why I gravitate towards these types of shops. But the whole purpose of this company is to be the best SBA lender in the country. So every day, everyone in the whole organization wakes up with that in mind, which creates a little bit different of an environment, especially, which I think is the biggest thing, the biggest takeaway for really a lot of buyers and sellers of businesses who, you're entrusting an SBA lender to get you to the finish line to retire yourself. You're going to want to make sure that SBA lender does it every day, day in and day out, and not just a bank that does a onesie or a twosie here or there, because then they're figuring things out on the fly. And, maybe you don't want to be the guinea pig in that testing environment. So the specialists within the industry, whether it's a non-bank lender or a bank who specializes in SBA, that's the direction people have been going the last really 20 years.
Yep. So let's dive right into it. And now there's a lot of SBA programs that are out there, and I know that you've got experience with them all. So let's assume, so I'm an entrepreneur and I am looking to sell my business, and I found someone that we've agreed to a letter of intent, or maybe we've done all the negotiations, and it turns out that the person that I'm selling the business to cannot afford to pay me cash for the business, and then I'm walking away. So they're going to have to go get a loan, and so there may be some type of owner financing that comes into play. We'll talk about that a little bit later. But what are the tools in the SBA tool belt that come to play and can help with this?
But when you're looking at these Main Street businesses, these businesses that sell for, upwards of, let's call it $6 million, these deals are being done with cash. They're being done with seller financing. They're being done with SBA 7A financing. That's the flagship SBA program. And it's often a combination of the three. So the sellers are probably going to be dealing with a buyer coming to the table with a 7A loan. Okay. And the maximum amount that they can borrow, $5 million.
Okay. So that's the maximum that they can borrow under the SBA program. So if I'm selling my business for $6 million, then that means that there's either got to be some type of cash that comes into it, or some type of seller financing. So how would that, let's say that the entrepreneur that I'm selling my business to, they've got $500,000 cash. And we've kind of worked through, we're not depleting all the cash. There's going to be working capital in the business to help it running afterwards. So don't want to kind of nerd out too much on that, but let's assume that they can get a $5 million loan. I'm selling it for $6 million. They're going to give me $500,000 of their cash along with the loan dollars, and I'll take that seller finance note back. How does that impact the SBA 7A program?
So it's a pretty common structure, right? The structure kind of varies depending on the bank or the lender. So we're a lender, so we have our ways of structuring transactions. We tend to be a little more aggressive as a non-bank lender. So we can get up to 90% financing in most of these cases where the buyer's bringing 10% down. I even did a transaction last month where it was a trade school and the buyer had worked in the business for several years as a teacher, and she was able to buy the business from the seller, her boss, and she was able to do it with 5% down. The seller, since they had a relationship, held 5% back, put it on full standby, which means no payments till the SBA loan's paid in full. That's a 10-year, you're parking that money away from a long time. But, when they have a relationship together, like if you're selling it to your employee, maybe you're willing to do that to help them out because they've helped you build a business. So that's a 95-5 structure. That's an interesting structure. It's one of the most aggressive structures you can get. And that's a good example of a case where that structure makes sense. Now, other than that, you have the 90-10 where SBA loans financing 90, buyers putting in 10. But a lot of buyers like to have the seller finance a little bit of the business, whether it's 5, 10, 15%. Lenders often like that too. Just keeps the sellers more engaged. A lot of sellers, guys, I understand. You want to cash out, you want to go to the beach, you want to sail off into the sunset. I would do the same exact thing. But just know that that's the norm. So at the end of the day, I think most structures are going to land with some amount of seller financing. I don't require it, but it's just a really good idea for the buyers and the lenders to have the sellers hold a little bit. So a lot of structures, maybe it's an 80-10-10, maybe it's an 80-10-5. They tend to vary depending on the deal, the lender, the buyer, et cetera.
Gotcha. So, but the important thing is with that is realizing that it's on full standby. You as the owner that's doing that seller financing, you're not going to get paid until the SBA is paid.
Actually, that's it. It only if it's going to be part of that 10% equity injection.
Okay.
Or whatever the required equity injection is. So actually, if we're doing a $2 million transaction and the buyer's putting in 200,000 but the buyer wants the seller to hold 10%, that there can be terms on that because the buyer has checked off their 10% equity injection requirement. So beyond that, it's really icing on the cake. And so the seller's holding 10%. Now, maybe it's financed over 10 years, maybe 5 years. It's based on what the cash flow supports. You're probably not going to get it paid back in 24 months. That's probably too short of an amortization.
Right.
But maybe you can do a longer amortization with a balloon in year 5. So maybe you can cash out in year 5, but the payment's it's not weighing the business down that much during especially those first initial years.
Gotcha. Okay. So the magic words are that 10% equity requirement. If that is going to be part of the seller financing, that's on full standby. But I love the creativity of even just saying, okay, well, over and above that, there can be some seller financing, and you can have repayment terms on that. That's cool.
That's it.
So what can all businesses be financed, the acquisition of the business financed through the SBA 7A? Are there any restrictions on asset class or industry or anything?
Well, it's got to be a for-profit business.
Okay.
It can't promote religion, can't deal with anything illegal on a federal level. So cannabis does not work. Hemp and CBD could work. And then there's a lot of other restrictions that are just, it's random stuff. But for the most part, most for-profit active businesses, meaning not passive, like owning an apartment building doesn't work, right? It's active operating businesses.
Okay.
They're going to be eligible, but eligible is one thing. Actually being able to get financing is another, and that is heavily reliant on the tax returns and the profit being shown on those tax returns. And you're looking at the last 3 years plus the interim year, and that's the key.
So how let's go back just a second. You kind of blew by it. So apartment income producing type of companies with what I believe, with the exception of self-storage, because I believe self-storage can be financed through the SBA.
Yep.
But having an apartment complex or a student housing complex, something like that, that's considered passive, not active.
Right.
Even though you're working in it every day, the way that the SBA defines that income, it's passive, correct?
That is correct. Yeah. And that's why just kind of working really closely with an SBA expert is helpful, because you wouldn't realize a marina is eligible. An RV park is eligible. A mobile home park is not eligible. A hotel is eligible. It's all these little nuances. And we got to remember, it's a federal program. These rules are made in Washington, and we just go by the rules, so I don't make the rules.
It's not Ray being a bad guy because he doesn't like my business.
Right.
Gotcha. Okay. So you, when a client comes to you and they start to engage you or another SBA lender, I love I love the fact that you talked about making sure that you work with an SBA qualified lender, because a lot of banks, maybe they've got a division that helps and does, that's all they do. And so it really does provide a lot of the information. But not everybody's there. And that's not a knock against any bank or any lender. but it's like when you're going to the doctor, or when you have a toothache, I want to go to a specialist that can make sure that they take care of my root canal or whatever. Um,
Right.
so a client engages you and they start to look and say, okay, here's the deal. Here's the transactions. Here's the 3 years of tax returns for the business. Here's the interim statement that kind of shows where we are year to date. And then of course you need to get all of that information from the person that's buying it, the one that's going to make sure that, you know, there's no liens or judgments or bankruptcies or anything like that on the person that's buying it. But as you're going through that, what are the big things that you look at when you're doing the analysis?
The name of the game is cash flow. All right. So if I were going to go into business for myself, knowing at some point I'm going to exit, every year I'm doing my taxes. What's your goal when you do your taxes? You want to minimize your tax liability. This is
What you give back to Uncle Sam.
Yeah, I mean, it's, you know, it's the laws there. You want to stay within the law, but there's expenses. And some people are more aggressive than others with what they expense, right? So just know that, you know, if I'm looking at 2018, 2019, and 2020 tax returns, often, you know, two consecutive years is what we're looking at in terms of showing enough profit to support the repayment of the loan.
Yeah, how's 2020 been for you? I mean, that's a whole separate subject
That's a whole nother thing,
talk about.
But the important thing is, if you're selling your business today and I'm looking all the way back to 2019 or really 2018, when are you filing the 2019 taxes? Somewhere mid 2020, but things have already gone into motion, you know, and so I mean, well, a year in advance is when you need to start planning. I mean, really 24 months in advance is when you start preparing your exit, in my opinion. And so you want to know that going forward. And I'm not saying don't expense eligible expenses, right? But I would document everything very carefully, because if there are expenses that you're running through the business, hey, you have a car, you use it for work, you want to expense it, fine. You can document that and kind of separate it in your in a spreadsheet or whatever, in your P&L really, and it shows like, okay, these are my expenses that are going to be going away after the sale. So when we're underwriting it, we know that cash flow is going to be there available to support the debt.
Gotcha. So the salary that I as an entrepreneur take, that maybe my spouse takes, or someone that's in my family that will not be there after the sale,
Right.
that can be used to pay the debt, to pay the loan back. So what is the documentation that you typically ask for in order to prove, okay, this is something that's not going to happen going forward?
I mean, on the car, it's the car bill, the W-2 for the, you know, family member who's not working in the business, but they get a salary. Sometimes you see some big one-time expenses. Sometimes there's a lawsuit, you know, and there's a big legal expense or something.
Mm-hmm.
You know, that's something that's not going to be recurring. So keeping those records is really important, and just preparing yourself for the sale, because the sale price and the loan, it's all based on these tax returns and the earnings that you're showing.
Okay. So you hit something that I want to kind of go off. This is not on our list of questions or anything like that, but I actually have had a couple SBA transactions that the clients were in an active lawsuit. And in the one that I'm thinking through, it was an actual building purchase. So I went through the 504 program, but I had to kind of document, okay, do they have enough insurance to cover what was going on and explain what was happening? Has that been do you have any experience with clients that are in a lawsuit, and how has that impacted the transaction? Is it just put on hold, or how do you work through that?
9 times out of 10, and it might even be 10 times out of 10, if you're buying a business or selling a business, let's say you're selling a business, you're not going to sell that business with pending litigation. The lender is going to want it to be satisfied before closing.
Yep. So as an entrepreneur that's looking to sell, you maybe need to adjust your expectations from a timeline standpoint. You maybe need to do whatever decisions you have to make when it comes to the lawsuit, but realize that that's something that's a risk that's out there that the buyer and the lender would be taking on, and they most of the time they really don't have an appetite to take that on. So just be aware of how that kind of works through.
Yeah, and
So
it's, even if it's an asset purchase, right, and you're not
okay.
taking the liabilities, there's still some liability there. And because you are filing a UCC, and maybe they have a judgment against the business.
Hmm.
And the other thing is, a lot of these lawsuits are going to be frivolous, right? And so the sellers are not wanting to pay or settle because they feel like they're not in the wrong, and so they just are going down the process, and then they want to sell their business. And a lot of those sellers end up saying, like, it's not worth it to keep dragging on. I'm just going to settle and get out there. So I get both sides. Like, you don't want to have to pay for something that you feel like you're in the right on, but it's just one of those things with in our country, you know, people can sue anyone they want, and you got to deal with it.
Mhm. So, so what is you mentioned if this is an asset purchase, and another one of our episodes, we talk with Peyton Holt, who is the entrepreneur's lawyer, and he kind of talks about from the legal standpoint, you know, why would you take an asset versus a stock sale from the SBA's perspective? Is there a difference? Is one better than the other? Is one preferred over the other?
We go with what's best for the buyer and the seller. I mean, often I would say 9 times out of 10, it's an asset purchase. But if the buyer is buying a business where there's some contracts in place, or there's a reason why a stock purchase, a license perhaps, and they want to assume that license, then they're going to move into the stock and own the stock of the business, and they're going to just structure it that way. But it's based on, you know, I say talk to Peyton on that and let me know. Because if it's a stock sale, we're going to have to get these documents. If it's an asset purchase, we're going to need these to be compliant with the SBA. And the stocks are a little more challenging, but nothing we can't overcome.
That's right. And I think that the name of the game for any loan is to make sure that you've got proper documentation. Dealing with the SBA, it is a federal government entity, and it's a bureaucracy that loves some paper. So just be prepared, but to provide all that. But that's where the value of having someone like Ray comes in and saying, look, I'm going to tell you up front, here's all the things you need to work through it. And if you're doing a stock purchase and you don't have stock certificates, then guess what? You probably need to start right now going and getting those drawn up, so that it's not something that, you know, 3 weeks, 4 weeks down the road, when we get everything approved and appraisals and all that stuff is back, then we're dealing with it. So having a lender that knows the rules of the road and advises you on what to do is critical. So, okay. So we talked about cash flow, and obviously, you know, the lender wants to know how they're going to get paid back. What are some other things that you as an SBA lender have seen that come into play from an analysis standpoint?
Well, you have, so on the seller side, you know, cash flow is a big thing, but you're also just underwriting the risk of the transaction. So some things that come up pretty often is, how is the revenue generated? Is it contract based? Do you have diversity amongst your clients? We see sometimes there's concentration issues. These things can impact valuation. They can also impact the chances of getting the loan approved. And it's a good motivating factor for, you know, the owner to start diversifying as early as possible, because the buyer's coming in, and if I'm talking to them, and 30% or more of the business, and really if it's 10% or more of the business is coming from one source, but let's say it's 30, you know, their plan is probably going to be, you know, I need to get in there and I need to diversify. But to get that deal done is so much harder than to get it done if it was already diversified. It might require more equity, more seller note, and deeper analysis, and then also depending on whether or not they have contracts in place, and what are the terms of those contracts. Are they long-term contracts, and have they been doing business with that customer or supplier for a long time or a short time, you know?
Gotcha. Okay. So a lot of that is things that an entrepreneur needs to be honest about themselves. I mean, they may have built the business with one or two companies, you know, like I once worked with a client that they did some very specific work for Walmart, and 90% of the revenue was from Walmart, and that's okay. But when Walmart starts coming back and saying, hey, We were paying you 20 cents a package for whatever you provided. We really need it to be 15 cents. And so there's some risk associated with that. And so you're just kind of walking through that, and an entrepreneur needs to be aware of that. So what are some non-financial things that you look at for when someone's coming in and buying the business?
Well, you also want to understand like how reliant is the business on the seller, like the person. What type of team do they have in place? How is this business going to be transferred to a buyer? How, what are the key relationships there with suppliers, customers, and is removing the seller from this equation going to cause some uncertainty in the business? And really just understanding that is a big part of it.
Mm-hmm. Mm-hmm. And understanding that, who's going to be left, the management team, that the person coming in. I mean, I love this client. I mean, I once had a client that was in the retail space, and then they came to me and said, okay, Greg, I'm looking at buying this business. And I drink a lot of beer, and I think I know how to make beer. So I want to buy this brewing company. And so it's like, well, I mean, your retail experience and your brewing, a food manufacturing and distribution experience, they don't relate. So help me understand how you really know what this business is that you can take on this business.
Yeah. I mean, if you set it up right as a business owner looking to sell, then it's just a matter of finding the right buyer who has either direct industry experience or some really good transferable skills to come in and take the place of the business owner. And so the buyer doesn't necessarily need to know how to run this business before they get into the business, but if they have some transferable experience, particularly experience managing people, managing a department, managing a budget, managing a P&L, all that stuff's going to translate very nicely into most businesses.
Gotcha. Okay, so let's talk about collateral. One of the things that the SBA is really used for is to protect the lender against, there's just maybe not a lot of tangible collateral there. I think of, like medical offices or attorneys offices, service companies that have a solid book of business, and there is value in that book of business, but they're not a construction company that has cranes and a fleet of trucks and land and a building and stuff like that. So as you come in, what are some things that when you talk about the collateral in the business, and then collateral that's owned by the person buying the business, that they need to be aware of?
One of my favorite topics, because one of the main reasons the SBA program was created was to allow for financing in these types of situations to preserve those jobs so that this seller doesn't just shut down the business. And also, a buyer might come in with a little fire in his belly, maybe add a couple more jobs as he's trying to grow it, or he or she. And so collateral is usually light in these transactions since we're financing a lot of goodwill. And what the SBA says is we're not going to ever say no to a deal because of collateral, but it's up to that individual lenders to decide and what their risk tolerance is. And that's where you're going to see a wide, variance across the spectrum. I'll speak for us, we're collateral neutral. So we're going to take all available collateral per the SBA's guidelines, but we're focused more on cash flow, which is what pays us back. And we do look at, it's really real estate and equipment is like what we're looking at. Most SBA lenders aren't set up to really liquidate receivables or inventory or IP. So really, once you've looked at the real estate and the equipment, there's going to be some level of unsecured loan that you're going to have to be comfortable with. And for us, instead of saying like, no, anything past this limit, we're just not going to do, which a lot of banks do take that approach because they just don't want a big, massive airball in their books, because if that goes bad, it's like a punch in the gut. So what we do is we just say, we just want to see more debt service coverage, cash flow for those larger unsecured deals. So it's like more of a sliding spectrum. If you have a decent, a smaller loan with a good amount of collateral, we'll be good with the SBA's minimum of debt service coverage, which again, that's what all of this SBA lending is based off of. That means for every dollar of debt, business is making $1.15 cash flow. That's a 1.15. Okay. So that's fine on the smaller end. And then as you go bigger, it goes up from there.
Okay. So what about, what are the SBA guidelines for personally owned assets? Like, do I have to pledge my car? Do I have to pledge my house?
Yeah. So this is one of those things that's also kind of up to the lender. But typically you're only talking about real estate, though I have seen lenders use marketable securities. I think the car is safe. But I focus on the real estate. Okay. And the guidelines specifically, and this is the guideline that the SBA puts out there. Again, lenders might be different because they, a lot of banks put their own requirements on top. But if you have real estate with 25% or more equity in it, the SBA is absolutely going to require that equity to be pledged towards the loan. Okay.
Okay. And that doesn't matter if it's land. It doesn't matter if it's like a rental house. It's any type of real estate that's got 25% or more equity in it.
Yeah, we're talking primary residences, rental properties. Vacant land is looked at a little differently. It's more heavily discounted. So you probably have more wiggle room there. But commercial real estate as well that applies.
Okay. So what are some things that you go through the underwriting process and you've done the analysis and you've determined the cash flow, you've understand the structure, whether it be a cash in equity or a seller note or a bank financing or financial institution financing, and you're comfortable with everything, you get it approved. A lot of times, obviously, when there's real estate involved, I think an appraisal and maybe an environmental review might be appropriate, might be required. What are some other types of appraisals? Like, have you seen equipment appraisals or actual appraisals of the business be required?
You're looking at an appraisal of the business. Yeah. It's a business valuation. And that's going to essentially be the tool we use to ensure that the purchase price is justified by a third party. So if the business is being sold for $2 million, you're going to want the business appraisal to be $2 million. I don't really get into equipment, but if there's a piece of real estate, we will do the real estate appraisal as well.
Okay. So just be prepared. I mean, with any type of transaction, I think that's pretty consistent, whether it be an SBA transaction, even if it's, for an expansion, not even a business acquisition. If there's going to be collateral real estate that's pledged, then you're going to have to get an appraisal. You're going to have to review that. There'll be title work. There'll be other costs associated with it. Just again, talk with your lender to make sure that you understand what's going to be required, the time frame that's required, and the costs associated with it. So
yeah, and the business valuations typically take about 2 weeks once you have all the info. They're going to get the same type of info we get. And, they're running about $2,500. The buyer pays.
And that's pretty consistent from what I've seen. What about key person insurance? I mean, you've got someone that I'm selling the business, and there's one person that's kind of step in, and he or she is going to be my replacement. So what happens if that person gets hit by a beer truck? That's a sad face day for a whole lot of reasons. So how does the SBA kind of protect itself and the lender protect themselves against that?
Yeah, and getting the insurances are a big part of the closing process, getting all your insurances in place, and of course you need all the insurances that are required to run a business. And then beyond that, there's always going to be a life insurance requirement for the buyer. Usually it's on the full amount of the loan. So if you're doing a loan for $1 million, lender's going to take an assignment of life insurance for $1 million on that new buyer. And, assuming it's $1 million business, no collateral. If there's real estate, that's a different story.
Mm-hmm.
but we have life insurance policies in place on pretty much every one of these business acquisition transactions we do.
Gotcha. So Ray, if you could talk to every single entrepreneur that's out there that is looking to sell their business, and let's say that they have, somewhere between 5 and 10 years on their horizon, what advice would you give them to be able to help facilitate the transaction? Because at the end of the day, I'm a seller. I want to get out. I want to check and I want to go to the beach. So what do I need to be doing to help you help me show me the money?
Yeah, well, and it's not even advice as much as it is education about the process, because people go into this not knowing what to expect. You sell your business once, right? Like a lot of them haven't done this multiple times, and even if they did, the experiences might be different. And even if SBA is going to be used, it could have been different than 10 years ago when they did it. The rules come
Yep.
out, they change every couple of years. So it's really mostly about education. And unfortunately, and it's one of the reasons I made my podcast, a lot of this information isn't readily available. There are SBA specialists all around the country, and in talking with them, you can learn and educate yourself. But they're busy, maybe they don't want to talk to a seller selling 2 years from now. So there's a little bit of shortage on the education out there right now. And it's always changing too. So
Yep.
getting the right information is key. Now, if the business, and this comes up a lot, if the business requires a license, whether it's a liquor license, or we deal with a lot of contractors,
Okay.
and the contractors require, you have a license to be an HVAC license or whatever. And that's one of the biggest sticking points. Like I'm doing a transaction right now. And by the way, one of the SBAs, and this impacts sellers because some sellers want to stay on, some want to get the hell out of there. The SBA will allow a seller to stay on for up to 12 months as a consultant.
Only 12 months.
They cannot stay on more than 12 months.
Okay.
So they can stay on for up to 12 months as a consultant, not a W-2 employee, not a key employee, a consultant to transition the business. So they were really big on that, changing hands the day after closing. And then the seller's just there to help transition to that new person right away. And a license sometimes is required to operate a business. And it varies on the state. I'm in Florida. So for example, like you have HVAC businesses and you have a license that you need to have, but you can't, you need to qualify the license, and you can't qualify the license unless you work for a year. So how can a buyer not coming out from a different industry qualify the license? It makes it really hard for that seller to sell. And what my client did was he essentially partnered with somebody. There was a couple employees in the business that the seller kind of trusted, and essentially one of them is going to qualify the license. So he's relying on an employee to qualify his license. The buyer is. Now, that's a lot of what happens if that employee leaves the next day.
Yeah.
So do you want to offer them equity? Do you want to do an employment contract? Do you want to give them a raise, a new title? Do you want to get two of them in place? You need a plan A, a plan B, a plan C as the buyer, but also the seller should think about that, because the seller helped this buyer make that happen, because it takes a lot of coordination, and it's a delicate subject when you're talking to your employees about, I'm selling my business before it's closed and I need you to do these things. Like, it's a very delicate balance. So if the business requires a license, and sometimes there's other situations in other states. I mean, sometimes you can rent a license, but what you can't do is the seller remain a key employee of the business after closing, which is what their original plan was. And it wasn't eligible.
Gotcha. Oh man. So having multiple owners with that business acquisition. So if I've got maybe me and two buddies are going to buy a business, and I'll own 70%, another person will own 15%, another person will own 15%. So is everybody on the loan?
20% or more is the cutoff. So if you own 20% or more, you personally guarantee. And if you're also a key employee in the business, the bank might ask you to guarantee as well, even if you're not 20.
Okay.
So
So
yeah,
if I've got a passive investor that's maybe providing some cash that's in there, but it's not in the day-to-day operations and they own less than 20%, then is I guess it's one of those things in my experience, the SBA policy may say 20%, but your lender can add any different requirements up on top of that
right.
that they have.
Yeah, and that's out there now, so people understand that. So if you're looking for a passive investor, people are knowingly keeping them below 20. I've seen 19.99.
Wow.
Which I do not recommend, by the way, at all.
You're just asking for more questions to have to be answered.
Right? You could have really just done 19 or 18. But I get it. A passive investor is not going to want to personally guarantee that. I think everyone understands. But yeah, so if you're doing it the right way. Now, the one thing I will say is often, and I'm seeing this more and more, and I don't like it, but people are thinking like, hey, I'm going to go buy a business. I'm going to raise money from investors, use that as a down payment, go get the SBA loan, right? And I'm going to run the business. But they have no experience, which isn't horrible, but you have no cash, no experience, no collateral. Like, what do you have? So we want to see the buyer have at least some skin in the game themselves. So if they do have investors and they need a 10% down payment, if the buyer out of their own personal resources is putting in at least 5% and the investor's putting in like 5%, like that, I think is fine. But anything skinnier than that, I get a little turned off.
Yeah, it's about, I mean, what a borrower is asking any lender to do is to trust them and to bet on them and their ability to run the business, to be able to continue to produce revenue, but just as importantly, if not more importantly, net income, in order to pay the loan back and build up the strength of that business to be able to allow you to grow and do all the things that we talked about at the very beginning. I mean, the SBA stepped in to say, look, we want to find ways to keep jobs open, to keep businesses running, because every small business owner out there knows that their impact on their community is so much more than a large conglomerate that, all the money leaves the business, leaves the community. So the SBA wants skin in the game from everybody involved. And so that's great news. So aside from knowledge and educating themselves and making sure that their books are cleaned up and that they've got documentation on, the ad backs and stuff like that, how can an entrepreneur that's got additional questions reach out, contact you, listen to your podcast and gain that experience?
I try to be as accessible as possible. So I'm pretty active on LinkedIn. So you could probably find me there. And my email as well is always open. So.
Okay. And I'll make sure that after this, that to provide everything like that. But again, entrepreneurs, if you are thinking about selling your business and you think there's even a remote chance that there might need to be some type of financing, reach out to Ray, reach out to an expert to be able to understand how that is going to impact you so that you can work through some of those, those nuance issues, like Ray was talking about the licensing issue. If they didn't have a plan B, plan C, plan D, then that could have really thrown that into a mess. And so having time to be able to react to that. So Ray, thank you again so much for coming on and sharing with us. Again, just want to make crystal clear for both of our sakes that these opinions are Ray's and mine, our own opinion, not that of our employers or any affiliates or anything. But y'all connect with Ray, and Ray, thanks so much.
Thanks, Greg. Appreciate you having me.
Okay, so cool. Now, obviously, as a banker, I can nerd out on banking talk and banking lingo all day long, but I hope that you really got a lot of good information out of our discussion with Ray. The top 3 things that I got was, 1, you need to understand the impacts of the structure, and especially if it comes to having a seller note. if part of the structure, part of your transaction has a lump of cash, but then you're taking a note back, then you need to understand how much of that note is a part of the purchase. Is it 10%, 50%, 20%? What is it? And then what are you going to be required in order to subordinate and not receive payments on? Obviously, if you sell your business for $1 million and then you take a 10% note back and that is counted as equity, then you're not going to be able to be paid for that note for years to come until the bank note is paid off. That really could put a cramp in your style if you're counting on that money coming in from a seller note. 2, it's important to understand what the requirements are in order to get a loan, especially if you're selling to a financial buyer, not necessarily a strategic buyer. Again, remember, those strategic buyers tend to be large corporations that have the cash on hand or are able to get loans pretty easily in order to acquire your company. But if it's a financial buyer, if you're selling to a partner or maybe an employee or something like that, then it's important for them to know that they have to have X amount of cash, or 10% at the very least, down in order to put into it. And if they don't, then they have to save up that cash, or you're talking some type of seller note or something like that. But working with your financial buyer, especially if it's, a family member or someone that's in your employee now, a key employee, a key vendor, something like that, to make sure that they have the cash on hand to be able to put that down when it comes time to give you your cash for the business. And then 3, having clean books. And we've heard this throughout the entire conversation from sellers, from buyers, from the CPA, and now from the banker. Having good, clean books and understanding what the income and the expenses are that are associated with you, the owner, and that can be kind of taken back and help to support any loan or any debt that needs to happen in order for you to get paid. So being very clean and detailed and being able to convey that information very cleanly is super, super important, and it allows the banker to be able to understand the business, understand the transaction, and get your approval quicker. Well, I hope that you have enjoyed this series as much as I have enjoyed putting together. I want to thank all of the entrepreneurs, all of the supporters, everyone that was so open and honest and willing to share their story with us, to be able to learn from them. Look, I've never sold a business, but I know people who have, and I hope that you have gained some information and it's starting to kind of get the wheels going a little bit as you're thinking about exiting your business sometime in the future. If I can do anything to support you or help you, to connect you with any of the entrepreneurs or any of the guests that we've had in the series, please reach out to me, connect with me on LinkedIn. This is the last episode of the series, but I want to ask one small favor to join us next week when we're actually going to be talking about, I'm going to do just a real short video and say, here are my highlights. Here are the top things that I took away from this entire discussion. I hope that you join us for that, and I would love to hear what top takeaways you had from the entire series. This is so critical for entrepreneurs who spent lifetime building their company to be prepared to exit their company in their own terms. Finally, if you have any ideas or any recommendations or any thoughts about what future content, what future series, what future interviews you would like me to do, I would love to hear from you. So if this series meant anything to you at all, please reach out to me and let me know how I can bring more value to you. If we're not connected on LinkedIn or Facebook, I hope that we do that now. And I hope that you join me next week for my top takeaways from the entire series. Until then, this is Greg Martin, the Entrepreneur's Baker, wishing you an amazing week.